I spoke to some of you last night and I kept using the terminology strong foundations. It's really important to build on strong foundations, and Steve's touched on those foundations earlier this morning. So I just put the disclaimer up. So myself, Alberto and Matt, we are authorised reps of Perpetual. Anything we say is general in nature, it may not be specific or appropriate for yourselves, so please seek independent advice relevant to your own personal circumstances. Okay, so what's on the schedule for today? So we're trying to base as much of our conversation and our presentation around a particular case study. It is based on real clients. We have changed their names, and we can't go through everything because otherwise we would be here until tomorrow afternoon. So we've called them the Smith family. I'm going to take you through the case study very briefly in a moment. So I'll take you through the case study. We'll just do a quick group discussion so it just sets the scene. That then sets the scene more for the guys this afternoon, but also a little bit relevant to the latter part of my presentation as well. So as Steve's mentioned, I'm going to take you through strong foundations. I'm going to take you through the most important foundations that you can put into place, because you've heard some fantastic presentations already on Friday, yesterday. You're going to hear a few more this afternoon. But if you are unable to work, if you are unable to generate an income, then all of those become irrelevant. It doesn't matter whether you've got the best business plan, whether you've got the most appropriate structures, whether you've got the world's greatest marketing. It all becomes totally irrelevant because you can't work, you can't generate an income, and all of those objectives, well, what's going to happen to them? What's going to happen to your wealth, your definition of wealth? Can you achieve that? If you've no longer got an income coming in, think about the example Steve just mentioned with his dad. Everything can fall apart. So the strong foundations is based around insurance. Then Alberto and Matt are going to run through building on those foundations. So if we've got the strongest foundations in place, we've got all the right types and levels of insurance in place, now you can start to build. What types of investments should you be looking at? Different asset classes, property, all those different types of investments. And then finally, getting yourself prepared to reap the rewards of those strong foundations. So we had the foundations in place, you built on them, you're going to come to the stage where you want to reap the rewards. Some of you will have seen this slide before, and apologies that it's quite small. The screen's quite small today. You do get a copy of the slides, so you'll get to see it anyway. But all we're basically saying, and if I get the right, it's not showing up. All we're saying there is that this is the specialist life cycle. So you start off as a recent fellow. You may then look to be setting up your practice rooms, growing your practice. You're then starting to look at planning for retirement succession. That could be around about age 55. There's no set time frames on that. And then we're finally moving towards retirement or working at less, as it tends to be with a lot of medico specialists, because a lot of you don't tend to retire. We've got several GPs who are into their mid-70s and still going strong, and other specialities as well. So whilst you continue to feel that you're capable of doing the job and you still enjoy doing your job, then you tend to carry on working. It might only be one day a week, but you still carry on working that little bit. So it's maybe retiring, it's maybe working a little bit less. But what we're looking at is what types of strategies are you looking at in those different areas or those different stages of your career. So if you're just a recent fellow, as Steve mentioned, you might be having that values, visions and goals conversation. You're also looking at your wealth and lifestyle protection, so the insurances, making sure you've got the right superannuation platforms in place, and Alberto and Matt will talk about that later on, looking at your debt situation, etc. Coming all the way over here to the far end, what are we talking about with regards to retirement? Well, we're making sure that your accumulation phase, so when you've been growing your super account, is now moved over into pension phase because it's more tax efficient. We're making sure you've got the right asset allocation in place to provide that ongoing regular income for you. And you also, obviously, you've got those considerations about succession, the estate planning, which Ben and Craig will talk to you about later on. Wrong way. Okay, so for the first part of the presentation, what are we looking to achieve? We want you to basically be able to go away, review your current arrangements and decide for yourselves whether or not you've got the right types of cover in place, whether you've got the right levels of cover and the right policy structures, and whether or not your current arrangements will support you, your family and your business and that's really important if anything goes wrong. Steve mentioned earlier about what makes a good financial advisor. A financial advisor can't have the answers to everything, and they shouldn't pretend that they've got the answers to everything. A little bit like yourselves, you have your own specialities, or if you're a GP, then the GP refers out to the specialist. If you're a specialist, but you identify that the needs might be with another specialist, you'll refer on to one of your colleagues. So likewise, whilst we like to see ourselves as your personal CFO, your Chief Financial Officer, what will we look at? We'll look at your financial strategy. We'll look at your debt finance, but if we need to make changes to your debt or finance, then we're going to bring in a finance expert. And you'll hear from Jack this afternoon. We'll also work hand in hand with your accountant because of those debt strategies that you'll look to put into place. Insurance, absolutely, that's the role of your advisor. Investment and investment into property. So two different elements there. Investment, absolutely, that's the role of a financial advisor. Property, that's the speciality in its own right. So again, you'll hear from Tal and Julian this afternoon with regards to property investment. It is, I say, it is a speciality. You really know what you need to know what you're talking about when it comes to property investment. What's the right area? They've got all the research behind infrastructure, what buildings are going on, what types of demographics are moving into that area, etc. Because your property investment shouldn't be, I want to buy the property next door to me because I like it, it's in a nice area and it's next door to me and I can keep an eye on it, and every time I walk past it I can say, there's my investment property. That doesn't work, or it very rarely works. So you need to be making property investment choices to help you grow your wealth, not because it happens to be the house next door. If the right place to buy an investment property is in Geelong and you live in Sydney, you buy in Geelong. Okay? Super, self-managed super funds. Again, so Alberto and Matt are going to talk about super and self-managed super funds later on. Absolutely, that's the role of your financial advisor. Accounting, legal, estate planning. So the role of your financial advisor is to have, or to be able to refer you to medico specialist experts in all of these different areas if it's not part of their role. So accounting, you heard from Marie on Friday, I believe. So again, medico specialist accountant. I can't stress enough the importance of making sure that your accountant is medico specialist and is used to working with and putting strategies into place for medical specialists. We have spoken to numerous people who've attended these courses who have had accountants that aren't specialists working with medical specialists, and there's been numerous problems when we've taken a look at their accounts, and it's cost them quite a lot in tax to put things right. And that's just basically because the accountant wasn't aware of how certain things happen, certainly with regards to professional services, the different income streams that you guys generate, and therefore their structures weren't right and their taxes weren't right, and it cost them quite a lot. Whereas if it had been right from the outset, that wouldn't have happened. So it's really important. So I'm not an accountant. I was saying last night but for me the most important thing is to make sure you've got the medical specialist accountant in place, followed by your medical specialist financial advisor, and those two need to work hand in hand together. So a little bit like you've heard from Marie, you're going to hear from Jack, you're going to hear from Tal. We've got a lot of mutual clients all together because we trust, we respect each other, but we know that they're experts in their field, and we also know how they're going to treat our clients, which is really important to us. Okay, so you are your biggest asset. What do I mean by that? Now this is just an example. You can change the numbers, you can change the percentage rates, you can do what you want, but if you take a starting income of 200,000 and you move that forward 30 years at a rate of 5%, now in the early years your income is going to go up a lot sharper than 5%, but then it's going to plateau out. So we've just used an average of 5% just to come up with a number. So over that period of time, your income is going to be $13 million. So if something happens, we talk about your goals, your objectives, you're building your wealth, that's $13 million that you're not going to have coming in if you do not have strong foundations in place to help you meet your everyday lifestyle expenses, and then also to help you continue to build on those objectives. So there's plenty of important reasons to insure. So is it going to happen to me? Unfortunately, it's going to happen to a lot of us in this room just purely based on statistics, or hopefully it doesn't happen to any of us in the room and it happens to a bunch of people in another room, but that's unlikely to happen. So 1.2 million hospitalisations from CVD in 2017-18. 48 people die each day in Australia from heart disease. So that's 1 every 30 minutes. You guys will know these stats as well, if not better than I do. 150,000 new cases of cancer in 2020. 1 in 2 Australian men and women will be diagnosed with cancer before age 85. That used to be 1 in 2 men and 1 in 3 women. So it's now, the ladies are now up to 1 in 2. One that we don't like to talk about, 1 child under the age of 14 is diagnosed with cancer every 12 years. Every 12 years, every 12 hours. 12 years would be a bit better. That mainly being leukemia is the big one there. More than 60% of cancer patients survive for more than 5 years. 1 in 4 globally will have a stroke in their lifetime, and 38,000 Australians suffered a stroke event in 2017. 1 every 14 minutes. So it does happen. Okay. So before we go any further, I just wanted to run through some stats with you, and I'm going to go through a few more stats in a moment. But what I want to do now is just take you back to the case study and just take a look at when Sig and Martha, as somebody's named them, when they came to see us, what was their current situation, what were their goals and objectives, what were the sorts of things that they told us that they were looking to achieve, and what was important to them. So, as you didn't do your homework, I'll quickly take you through this. So they're both medical professionals. Sig's a forensic psychiatrist, recently entered private practice, so we're going back a couple of years now. Martha works as a full-time radiologist, and she's an employee. They've got 2 young children. They've enrolled them in private school. So that's, to us, that's really important. It's a really important objective for them, something for us to really take note of. They've enrolled them in private school, and in a moment we'll see that one of their really important objectives is to make sure that their children get the education they want them to get, and also through university as well. The estimated cost of their private schooling is $30,000 per annum per child. Good luck with that. $30,000 minimum on the fees, plus then all the expenses that go with it. So Sig and Martha enjoy their chosen careers, provides fulfilment, but they feel that other areas of their lives are neglected. So they want to spend quality time with their children. They'd like to attend their children's activities, take weekend getaways, all the things that Steve mentioned, all the things that you put up on the board. This is really important to Sig and Martha. They would like to go to Japan and a few other places. Okay, so something that we need to think about as the advisor that Sig mentioned, he's an avid mountain bike rider. Okay, insurers don't like mountain bike riders. It depends on how serious and how regular that mountain bike riding is, but it's just something for us to note as an advisor that Sig's say he does do a lot of mountain bike riding. Martha enjoys gardening. They're okay with gardening. Unless there's brown snakes around the place, but after 13 years in Australia, I've just about got over the fear of snakes. But the typical one that we hear all the time, they're time poor. So they want to do all these things with the family, go on holidays, spend more time, but they're time poor. Okay, so they're financially comfortable. They feel they could be doing more. Their priority is to support their kids through private schooling and university. So again, that's something for us to take note of. Priority, getting the kids through private school and university. They want to be debt-free if unfortunately something happens to them. They don't want debt hanging around as a noose around their neck, were their exact words, if unfortunately something happens to them. And they'd like to reduce their tax bill, as we all would. And also have some plans in place for their retirement. Again, no plans in place for retirement. 2 big ones. They have no wills. So they've got 2 young children. They've got no wills, they've got no estate planning in place whatsoever, and they're not sure who their beneficiaries of their superannuation accounts are. Okay. So another one, going back to Steve's comments about what's the role of the financial advisor, they don't know what their living expenses are. They know money's coming in, they know the bills are being paid, but they don't know what their living expenses are. They don't know what their living expenses are, they can't plan. They can't put the strong foundations in place. Okay, so you took the quick flick through the case study. So hopefully some of the things that you would have identified is that they've got debt on their main family home of 1.227 million. They're paying P&I at 4.2%. Should probably, principal and interest, yeah. So that should probably begin with a 2. Yeah. The practice rooms, again, principal and interest, that's 6.5%. Now, whilst it is an investment loan, you'd expect to pay more, you wouldn't expect to still be paying 6.5%. So again, that's something that needs to be addressed. And again, the same with the investment unit. Okay, their current super arrangements and their only insurance arrangements are currently through Aware Super, also known as previously known as First State Super. So they've got the default insurance, so SIG's got 205,000, Martha's got 228. Sorry, that's their death cover, and they've got the same level of TPD cover. Their TPD cover is what we call any occupation. So there are a few of the details and information they gave us, but I say for the sake of time, we just put down some of the main ones. So we'll pick up on some of those areas in this presentation, and Alberto and Matt will pick up on some of the others in the later presentation. So one big question we get asked with regards to putting those strong foundations in place, well, it's okay me putting these insurances into place, paying all these large amounts of premiums, and they can be large amounts of premiums. We've got clients paying over 100,000 insurance premiums per year. That's not unusual. Insurers do pay. Provided that your claim meets the policy terms and conditions, they do pay. So as an example, and apologies that these stats are a little bit out of date, but the insurance industry is getting a little bit candid with the figures that they release and the way that they release them. These figures have actually got higher, so although it goes back a few years. But across the industry, in income protection and business expenses cover, this is new claims and ongoing. In 2016, the industry paid 2.65 billion and was paying 63,580 claims. They do pay. They paid 1.72 billion in total and permanent disablement. And excuse the terminology, I'll explain those in a second for those of you that aren't too sure. Trauma cover, we're talking heart attacks, strokes, cancers there, as opposed to a visit to the trauma department because you broke your arm. 784 million. Death policies, that's pretty self-explanatory, 4 billion. So in total, the insurance industry paid out over 9.2 billion in claims in 2016. I don't work for an insurance company. I'm quite happy to knock insurance companies when they deserve it, but they did pay out 9.2 billion in 2016. So, okay, just taking a look at what types of claims. So again, we think that it's never going to happen to us. Accidents on income protection claims. These are stats for an insurance company called BT Life, but the percentages and the types of claims are very, very similar across all insurers. 20% was caused by accidents. That's okay, so that's your broken arms, your broken legs. That is the trip to the trauma department. However, 20% on mental health claims. That is the one that is rising and becoming more and more common. It's also one of the hardest ones to prove. Now, especially on income tax and TPD, it is extremely difficult because a lot of it can come down to one specialist's opinion, potentially against another specialist's opinion as to whether or not that client is unable to perform their duties due to mental health conditions. Musculoskeletal, I've got a bad back. That's the one that insurers don't like because if somebody says they've got a bad back, they can't really disprove it. Cancer, self-explanatory, 15%. All of the conditions, 12 that aren't covered off by these. Neurological, 6. Cardiovascular, 5. Gastro, 3. Infectious diseases and respiratory, 1. Another really important fact, the average years that those policies were enforced before there was a claim was only 3.5. So clients had only held the policies for 3.5 years before a claim went in. Okay, and the average age at claim for income protection, 45. That's because that's when we start to get old and we start to ache and we feel the need to put a claim in. Trauma claims, a little bit more up to date, but again, just utilising BT's figures. Again, other insurers' numbers are the same. So it probably wouldn't come as any surprise to you that the most common trauma claim is covered off under the definition of cancer. Quite a broad area there. Cardiovascular, 22, neurological, 5, other conditions, 6. That is deliberately that way around because we wanted to highlight neurological. This, again, on trauma, the average years enforced before a claim, 5.9 years, only just under 6 years before people are putting a claim in, unfortunately, on cancer. We've had 4 claims come in the last couple of weeks, 2 cancer-related, 1 mental health, 1 accident. So again, going back to the insurers do pay, those insurance claims will go through. But those policies one has been in place long term, the other 3 have been in force less than that 6-year period. And the average claim, 3 of them are under 49, one is 50. So they're bang on that. But what I'm getting at there is it happens, and it happens to people younger than we probably anticipate. Okay, so what's your plan B? If you're not going to put a strong foundation in place, what are you going to do? You can self-insure. If you feel as though you've got sufficient assets that you don't need insurances, then by all means self-insure. You're going to be utilising those assets that in theory you're building up for your retirement, for you to enjoy your lifestyle in later lives. You're going to be using all of those assets to cover your income. If you're earning $20,000, $30,000, $40,000, $50,000 per month, that's quite a lot of your personal assets that you're going to be utilising to self-insure. Okay? You will come to a stage where your assets are such that you can self-insure, or you can certainly look to part self-insure and also utilise insurance policies as well, and you can look to reduce those levels of cover. So your financial advisor's role is not always to be talking to you about you should be increasing your levels of cover, you need to take out this policy, etc., based on your new circumstances. Your new circumstances may be that you've just cleared, that Sig and Martha have just cleared their 1.2 million debt. Well, if they've cleared their 1.2 million debt, or they've cleared 200, 300, 400,000 of it, then that's cause for a review to see, well, do we need the current levels of cover that we've got, or can we look to reduce it a little bit and save you a bit of premium? We will take that premium off you and put it into your wealth building, but at least it saves, you're not paying it on insurances. So that's a positive. But that's part of your advisor's role as well. It's not always to have you paying more premium. Where we can, we look to reduce that premium for you to make sure that your insurances are meeting your circumstances. Friends or family, do we really want to need to go to our friends and family and ask if they can support us through a time of accident, of illness, because we haven't looked to put cover in place for ourselves? Like to say, sell your assets, so pretty much the same as self-insuring. Self-insuring could be you happen to have the money in the bank as opposed to selling assets. Do you really want to sell assets? It's a forced sale. The last thing we do from an investment perspective is do forced sales when it might not be the right time to sell. But in this instance, you've got to, because you've got no other means of supporting yourself. Or go to the bank. As medico specialists, as crazy as it might be, in times of need, the bank will actually lend you money because you're medical specialists. They won't lend me any money, they won't lend Steve any money, but they'll lend you guys money because you're medical specialists. But again, not a good idea, because if you're taking on more debt and you don't know what the situation is with regards to being able to repay that debt, that's really not a good idea. Okay, so just to make sure we're clear on what are the types of cover that you should be looking at. Death cover. If your circumstances warrant that you should be considering death cover to cover things such as debt, school fees, making sure the family are looked after. If unfortunately something happens to one or both of you, then death cover is really important. Total and permanent disablement. So again, a lump sum that's paid if you're totally and permanently incapacitated. And we'll talk about that definition in a second between any and own. Trauma cover, so as I've already said, that's not the trip to the trauma department, it's that cancer, the heart attacks, the strokes, etc. Income protection, so income protection policy. Can I just have a show of hands who's got an income protection policy? Please all put your hands up. Nearly all of you. Okay, not bad. That's probably one of the best percentages that we've seen in a long time of a group of delegates that have actually got an income protection policy. I'm going to talk to you in a second about why you have to review your income protection policy. Okay, you might think you've got the platinum of platinum policies, and you may well have. You still need to review it, and I'll tell you why in a moment. So an income protection policy is a policy designed to pay you a regular monthly income should unfortunately you be unable to work due to an accident or illness. Business expenses. Has anybody in the room got business expenses insurance? Yep, okay. Appropriate for people that run their own business, have got their own rooms, employ their own staff, so you've got fixed expenses of running your business. Okay. What's the difference? So it provides you a monthly payment to reimburse the fixed operating costs of your business. Flick that over to income protection, it pays you a monthly payment to reimburse you to cover your living expenses. So what you don't want is a $20,000 or $30,000 monthly payment coming in on your personal income protection policy to cover your living expenses, and then having to pay 2/3 of it over here to keep your business running. Okay? So when you get to that stage, business expense is really important. It's the least discussed insurance out there. For some reason, financial advisors don't like talking about business expenses to their clients. If you need it, they should be talking to you about it. Okay, so death cover. So what you need to think about, who's reliant upon you. I mentioned that 30 years worth of earnings, that's 13 million. Believe me, that is nowhere near what some or all of you in the room are going to earn over a 30-year period. I'm just using that as an example. So we want to make sure waiver of premiums, if unfortunately you do die, then everything else is covered off. Terminal illness benefit, so if you have got less than, it's now on most contracts 24 months to live, so if a specialist confirms that you've got less than 24 months to live, the death benefit will be paid out to you, basically in order you to get things in order before unfortunately you pass away. So whether that's sorting your estate out, whether it's the opportunity to take that last round the world trip with the family, whatever it might be, that's what the terminal illness benefit is there for. You may have a contract that says 12 months on it. If it's an older contract, the likelihood is that that's been upgraded to 24. If it's a good policy with a good insurer, they'll have upgraded it to 24. But it's something to check on with your advisor when you're going through your policies. Beware of accidental death cover. So you may have a policy that only covers you for accidental death cover, and that's exactly as it sounds. If unfortunately you die due to an accident, the policy will pay. If unfortunately you die due to an illness, it won't pay. Okay? So really important that you fully understand what type of death contract that you've got. Total and permanent disablement. Okay, so this is really important. Who's reliant upon you? Remember, if you've been diagnosed or you've become totally and permanently disabled, you haven't died, you're still here. So probably the person that is most dependent upon yourself and your insurance contract is yourself. Okay? So don't forget yourself when you're thinking about who or what do I need to consider with regards to total and permanent disablement. You need to be totally and permanently disabled, as it says. Okay? So that's a diagnosis by a medical specialist that says you are totally and permanently disabled from being able to work. And I'm using the terminology work because then I can come on to the next part with regards to, or the next but one, own, any or home duties. So I'm just going to focus on own or any, and we've just had the perfect definition of if I have an any contract, then I have to be totally and permanently disabled from being able to perform the duties of any occupation for which I'm reasonably educated, trained or experienced, or the one they've added, from which I have any past experience. Flipping burgers at McDonald's, okay? And again, that's a little bit flippant, but you get where I'm going with that. So using the example of a surgeon gets a little bit of the shakes in their hand. Doesn't matter whether it's left or right, they're a surgeon, they're an ophthalmologist, then they are deemed to be, if they have an own occupation, this is why it's really important, they are unable to perform the everyday duties of their own occupation, they would receive a successful claim on their TPD policy because they can't perform the duties of their own occupation. If they have an any occupation, not only can they still perform lots of occupations, but they could go back to consulting, lecturing, still earning a good level of income, but certainly not the level that they were earning before because they can't perform surgical procedures. Okay? So that's why it's really important for medical specialists to have an own occupation definition. Okay? TPD buyback is just an additional benefit that you can have with a contract, which means that if you, it sounds a bit crazy because it's a TPD buyback, but if unfortunately you have to put a TPD claim in, depending on how your policy is structured, that may cancel your death contract. A TPD buyback benefit enables you to reinstate the death benefit because you may still need that death benefit even though you've had quite a large payout on your TPD. So again, that's part and parcel of your advisor's role to identify what exactly it is you require and make sure that the policies are structured correctly for your requirements. Trauma cover, so unlike TPD, it is specific, it has specific policy definitions. Cancer, heart attack, stroke. Again, really important that you're with an insurer that maintains up-to-date definitions on the different conditions that are specified, i.e. heart attacks. The definition of a heart attack has changed over the years. Okay? You want to make sure that your insurer is changing their definitions in line with those upgrades of medical terminology. Are you covered for occupationally acquired HIV, Hep B and C? Are you prone to, or are you putting yourselves at risk of acquiring occupationally acquired HIV, Hep B and C? Also referred to as needle stick cover. Don't think that you have to be pricked by a needle stick to be able to claim on that type of cover. It's a blood-borne disease. So if it's blood splatter, you would be covered if you'd acquired. Again, trauma reinstatement, so the same thing. If you claim on your trauma buyback, if you claim on your policy, you can reinstate your death cover. Trauma reinstatement, again, which is an additional benefit, what that means is if you claim on your policy, usually 12 months later, you can reinstate that policy, and the only thing you're not covered for is the condition that you put the original claim in for. So you had a heart attack, you got the payout, $200,000, $300,000, $400,000, $500,000. You reinstate your policy 12 months later. Unfortunately, you then have a stroke. The policy will pay again, and then the policy stops. So you can only reinstate once if you have that benefit on your contract. I haven't made a mistake on my slide here. That should be red on income protection. So income protection, the foundation of all financial planning. So pleased to see that most of you, nearly all of you, put your hands up with regards to at least you've got income protection in place. The reason that's in red is that is how your advisor calculates the amount of income protection that you're allowed to have. So on the first 320,000 of your income, you can cover 75% of that. So I can quickly tell you that's 240,000, that's 20,000 per month. So you'll note there that you were earning 320,000, you can only insure for 240,000. So straight away, your monthly benefit is going to be less than you're earning because the benefit you receive is gross. So it's the equivalent of your gross income pre-tax. Okay, you get a tax deduction on the premium, but the benefit itself is gross. On the next 240,000, you can only cover 50%. That's 120,000. That's 10,000 per month. That's 30,000 per month total now. So you're now covered for 360,000. You were earning 560,000. Okay. Okay. So then anything over and above, we're now on 560,000. You can only insure 20%. Okay. So quick calculation. But if you're earning $1 million per year gross, you can only insure $37,000 per month. So you're earning over 80,000 per month, you can only insure 37,000 per month, maximum. Okay? And anything over that 30,000, there's only two insurers, in fact there's only two insurers that will do it. The amount over 30,000 is payable for a period of only 2 or 10 years. Most insurers will pay more for 2 years. There's a couple of insurers that will pay for a period of 10 years, and one of those is just about to withdraw their contract. Okay. So, yeah. So all insurers will pay 30,000 for the period, depending on how long your benefit period is. So normally age 65 or 70. So unfortunately, you put a claim in tomorrow. If it's quite severe and you're never going back to work, it will pay all the way through to age 65 or 70. 30,000 maximum. You may have a contract in place that is indexed over 30,000, and that's fine. That will pay all the way through to age 65 or 70. But if you were taking a contract out today, maximum 30,000, yes, it will index. However, all insurers will actually offer more than 30,000. Some will offer 40. Some will actually, or a couple will go to 60. All except two insurers, that additional amount over 30,000 will only pay for 2 years. So if you took out 40,000, you'd have 30,000 paying all the way, but the additional 10,000 would only pay for 2 years. So you'd have 40,000 for 2 years, and then it'd drop down to 30, okay, ignoring indexation. The couple of insurers that do 60,000, they will actually do the 60,000 for 10 years, then it drops down to 30, again, ignoring indexation at that stage, okay? So again, just be aware of what your contract will do and will it see you through your career. Because if you need those higher levels of cover, then is 30,000 going to be enough? Or if it is a bit more, is 2 years going to be sufficient for you? So you want the maximum cover that you can for the maximum period of time. Okay, the big one, endorsed, agreed and indemnity. Is anyone aware of what an endorsed or what an agreed contract is? I know some of you do, but okay. So basically an endorsed or an agreed contract, and there is a little bit of a difference, but I'm going to keep it simple and just say agreed. So an agreed contract is where you've agreed or proven your income at time of taking out the contract, so therefore at time of claim you don't need to prove financial evidence. So it doesn't matter whether or not you're, so if you've got this contract in place and you've got 20,000 monthly benefit, you should have an income of 320,000. Okay? If you've got an agreed contract and you are only earning 220,000 at the time of claim, you still get the full 20,000 benefit. Doesn't matter what you're earning at the time of claim. If you've got an indemnity contract, you have to prove your income at time of claim. So if you took out a policy that's based on an income of 320, a few years down the track you're earning less and you put a claim in, your claim would be based on your income at the time. Better contracts have a 3-year look-back window, which I'll come to in a moment, but basically it's on the income that you're earning at the time, or maybe within the last 2 to 3 years. Okay? So it's not guaranteed. Okay? As of July the 1st, 2020, you can no longer get an endorsed agreed contract. Okay? So you cannot get that guaranteed contract any longer. If you already have it in place, then it cannot be taken away from you by the insurer. They might price themselves, or they might price you out of the contract, but they can't take it away from you. Okay? So if you've got endorsed agreed, great, but I'll touch on that in a second. You can only take out an indemnity contract. So there's nothing wrong with an indemnity contract. I'll come on more to that in a moment. Ideally, you want a contract which will cover you if your income is affected, if your duties are affected, or if your hours are affected. Some contracts will cover all 3, a lot only cover 2. Okay? Waiting period, so how long are you going to wait before your contract kicks in? That's down to your personal circumstances, down to the assets that you've got supporting you. It could be down to the amount of sick leave that you've got if you're in an employed position, in a hospital position. So again, taking into account your personal circumstances. The norm that we see is either a 30-day waiting period, so you have to be incapacitated for 30 days. All policies are paid monthly in arrears, so you're going to go 60 days without having any income coming in, but from then on you start to get the monthly income. The other popular one is a 90-day wait. Same scenario, 90 days incapacitated. From then on, you start to accrue the benefit, but you're going to go 120 days before you receive a benefit. So as long as you're comfortable and you're aware that you're going to go that extra month before the income actually comes in, then you can make your decision as to whether a 30 or a 90-day benefit is appropriate. There are different waiting periods. Those are just the 2 most common ones that we tend to see.
Can I ask, if you want to increase your agreed value, do you have to prove your income at the time to make that increase?
Absolutely, yeah. Did everyone hear that? So if you've got an agreed contract and you want to increase your agreed contract, so basically increase the guaranteed monthly benefit that you're going to get, at time of applying for the increase, you would have to prove your income at that time, because then it becomes agreed and it's locked in. If your income then falls subsequently, that doesn't matter, it's locked in. Okay, so income protection. Most of you put up your hand to say you've got an income protection contract, which is fantastic. Some of you will have that endorsed agreed contract. You'll have what we call a level premium, and I'll come on to that in a moment. But please, if you feel as though you've already got policies in place, you've got all your insurances covered, that's fantastic. But please, if you take nothing else away from this presentation, please go back and review your income protection policies with your advisor. Why? Because of this. So the insurance industry has reported losses of over 3 billion in the last 5 years, and it's 1.4 billion in the last 12 months. Okay? Now, we don't feel too sorry for the insurance companies, because that's on their insurance protection book of business, on their lump sum book of business, so their death policies, their TPD, their trauma, they make a lot of profit. So overall, the insurance companies make profit, but they lose a lot of money on their income protection book of business. Okay? That's due to competition in the market, it's due to increased claims, it's also due to the low interest rates, which I'll explain in a second. So there's a lot of pressure on the insurers with regards to income protection. APRA, the regulatory body, has basically said sort yourselves out, as we're going to impose some big capital adequacy requirements on you. So one of the quickest ways for the insurers to sort themselves out is to review their premium structure and basically increase premiums. So over the last couple of years, we've seen insurers increase their premiums. We've seen them increase level premiums. And there's a misunderstanding out there that a level premium is level, it is not going to increase other than in indexation. That is not strictly correct. all insurers reserve the right, it's in the contract, that they can adjust the level premium base. So it can go up if they need to increase it, okay? And there's a lot of, say, misconception out there that that isn't the case. That is the case, which is why people with level premium contracts have seen their premiums go up. Over the last 12 months, we've seen premium increases between 10 to 100% on existing level premiums. So we've seen some premiums double. And we expect to see more, okay, as insurers adapt and take on board what APRA have told them they've got to do, okay. So I've mentioned the endorsed agreed value is no longer available. So some of you will have rushed down. I know we had a conversation last night and we were basically run off our feet coming up to 31st of March last year, getting applications in to complete prior to June 30th to get the endorsed agreed contract in place. To be honest, wish we hadn't basically run ourselves off our feet because of all these premium increases that are coming in. It probably longer term it wasn't as important as it seemed at the time. However, there are more changes coming in onto insurance contracts that will now affect the indemnity contracts that are currently available. So an indemnity contract has all the bells, all the whistles of an endorsed agreed contract. It just means that you have to prove your income at time of claim as opposed to it being guaranteed. The better indemnity contracts give you a 3-year look back window. So going back to your question, if you've got 3 years worth of good levels of income, you can look back 3 years to prove the level of income at time of claim. So again, your advisor would always be reviewing your levels of cover in line with your previous year's income if you've got an indemnity contract. Some insurers have got a 1-year look back, some have actually got a 2, but the better contracts have got a 3-year look back. So I'm only talking indemnity contracts here, okay, because agreed is agreed. Come October the 1st, 2021, all contracts issued after that date will only be able to have a 1-year look back window. Okay? So if during the previous 12 months, putting pregnancy to one side, if you were not feeling too well, so you worked a few less hours, maybe had to go and have some treatment, go and see a specialist, so your income was down over that 12-month period, then you need to take time off work and put an income protection claim in. It's going to be based on the last 12 months. Your income's down, you get that pro rata payment. Okay? So rather than having the 3 years, because the year before that or the year before that, your income was absolutely fine, you will no longer be able to do that. On the new contracts, if you've already got an indemnity contract in place with a 3-year look back window, you can still look back 3 years. Okay? So I mentioned insurers are reviewing their premiums. So the biggest area that is being looked at the moment is endorsed or agreed contracts with level premiums. So the Rolls-Royce Platinum contract is the one that is really now moving forward is going to be under pressure. Okay? One other big reason that is affecting those premiums or the insurers reviewing their premiums, I mentioned interest rates. Well, what's that got to do with insurance premiums? When insurers gather your premiums, they put them on deposit. So remembering that we're talking about millions and billions of insurance premiums, the insurers put that money on deposit. So go back 24 months and beyond, they were getting 3-4% return on that cash deposit, then getting 1%. That's a huge difference in their revenue line to help support the income protection premiums. So therefore, the premiums are going up because they've got less interest coming in off those cash deposits. So although we might not think about it, deposit rates actually affect your insurance premiums. Okay, so the Rolls-Royce, the Platinum contract will be under pressure moving forwards, the endorsed agreed level contract. So your advisor needs to be talking to you about different options. Well, what can I do about this? I've just received notification that my premium's going up by 30, 40, 70, 100%. That's not, it's affordable, but it's not acceptable. It's not a good trade-off between value versus the reward. So you want to do something about it. You can push out your waiting period. That's one option, but that might not be what you want to do. You've specifically set your 30 or your 90-day waiting period. You can go to step premiums. You've paid years and years of level premiums. You're now going to go to step, so you've kind of overpaid on those premiums because you're not going to reap the long-term benefit of a level premium. Or you can go to indemnity. And we never thought that we'd be potentially telling clients to reduce their endorsed agreed contracts and take out an indemnity contract. But that's one of the options that we're seriously considering with our clients at the moment, especially for those that are in established positions where you know full well that if we have to do that 3-year look back on income, you're not going to have a problem getting the full monthly benefit. Okay, so you might, for example, if you've got a 20,000 endorsed agreed or agreed monthly benefit, you might say, well, okay, what I'll do is I'll reduce that down to 10,000. I'll take out an indemnity contract as well for 10,000. So I've still got my 20,000 monthly benefit. I'm happy that I can prove my income at time of claim. So I know I'm going to get the 10,000. I have to prove the other 10,000. That's not going to be a problem. And I've reduced my income. I've reduced my premium because I've now got half of it on the indemnity contract, which traditionally is about 20% lower premium than an agreed contract because it's not agreed. So the insurer, doesn't, because they're not as tied in, they're not obligated to pay that monthly benefit, the premiums are less. So that's one way of reducing your premium. You may go all the way and say, I'm going to take my endorsed agreed down to 1,000 per month and I'll have a 19,000 indemnity contract. Okay, so why am I keeping this endorsed agreed contract if I've only got $1,000 per month benefit? Because if you've got it, you've got it. And it can't be taken away from you. So if for some reason down the track you ever wanted to make that contract guaranteed again, provided you can provide financial evidence, you can up that endorsed agreed back up to 20,000 and reduce the indemnity down to 1,000 if that's the appropriate thing to do. So you've got all the options available to you. To do that, you want to be talking to your advisor about taking out an indemnity contract now. But I'm already fully covered, I've got an agreed contract, why would I do that? Because you want the current indemnity contract, the one that gives you the 3-year look-back window. As we speak, and we don't know enough about them at the moment, we don't want the contract that's coming out in October because it's only going to give you the 1-year look-back window. One of the reasons why we don't, as we speak, want to take out the one that's coming out in October is because the policy contract is limited to 5 years. So at the moment you take out a contract, the contract just runs all the way through to 65, 70, whatever benefit period you've got. The new contract's a 5-year renewable contract. So you're definitely going to be able to renew the contract. However, when your contract stops, you will renew it on the contract that is available at the time. So we take out a contract in October and I'm covered for everything as I am now. And as an example, I'm covered for mental health conditions. 5 years down the track, I go to renew my policy. It's one of the new style policies and the contract that is on offer at the time by the insurer no longer covers mental health conditions. So when I renew my contract, I'm no longer covered for mental health conditions because that's what's available at the time. Okay? Whilst the insurer can't make changes to your contract that are detrimental to you, they're not making changes to your contract that's detrimental to you because your contract's finished. And they're offering you the renewability of taking out a new contract. The new contract does not cover mental health conditions. So you're now no longer covered for mental health conditions. So if you take out an indemnity contract now, even if it's for the minimum amount, it gives you the flexibility moving forwards when we start to see the effects of the premiums. Unfair contract terms, this is big. Okay, ask your advisor if they're aware about the unfair contract terms rule, which is coming in on April the 5th. Okay, this is coming from the Royal Commission. It's further changes from the Royal Commission. It's been brought in to protect the clients. Some of the new changes protect clients, some to me are detrimental to clients. But it's things such as if you've got an exclusion on a policy, it was put there 10 years ago, you go to put a claim in, the insurer refuses it because you've got an exclusion. One, you could argue your advisor should have been reviewing that for you along the tracks. But two, if that exclusion isn't really relevant at the time of the claim, even so it's been declined, you have now got lots of ways of recourse to challenge that that decline on the claim and potentially get it overturned. You can do that anyway, but there's now more ways of doing that, more guidelines in place. One big one is that if unfortunately you miss your premiums for any reason, we've always been able to get policies reinstated as long as it's within 2 or 3 months. We've been able to get them reinstated. If you get to the stage where you'll be able to miss the first premium, all insurers will do that, but if you miss your second one, a lot of insurers will send you a cancellation notice, but we can always get it back into force. We've always been able to do that. You get that cancellation notice, your policy's gone. The insurer normally within 60 days will let you take out a new contract. Guess what? It's the new contract. Okay, so if you're on October the 5th now, new contract's in place, you've got an endorsed agreed contract, you happen to miss your premiums for whatever reason, and you get that cancellation notice, your endorsed agreed contract is lost forever, and you end up with one of the new indemnity contracts. That also is the case if the insurer messes up and does not collect your premium, you lose the contract. Okay, so I'm struggling slightly with regards to how that's beneficial for you as clients, but that's one of the new rulings that's coming out. Okay, still talking about income protection and just saying that it's really important to review everything as your circumstances change. So as you become a specialist, you want to make sure that it's relevant to your own occupation. Okay, you're going to have a change to income. So as your income changes, make sure you're reviewing your policies. That's also all your policies as well, as your circumstances change, but in particular your income protection. Your practice and business expenses. So has business expenses now become something that you should be considering? You've now got greater commitments, so you need to make sure that those commitments are covered by your monthly benefit. And then finally, do you need more comprehensive cover? So if you've got that to 65 contract, do you want a contract that runs to age 70? Because you feel that's going to meet your requirements more. Okay, most insurers now run their contracts through to age 70, so even if you've got a 65, they'd let you upgrade to a 70, subject to underwriting. So business expenses, it's a 1-year contract. The reason it's a 1-year contract, not through to age 65 or 70, is because the insurers are basically saying that we're going to cover you for 12 months and enable you to get your house in order. Because if it looks like you're going to be off for more than 12 months, you need to be making some decisions with regards to your business. Are you talking to your landlord if you're not the landlord? Are you having to unfortunately retrench your staff because you're not going to be coming back to work? So it gives you 12 months to get everything in order. So therefore it's actually quite a low premium for even $20,000, $30,000 monthly benefit on a business expenses contract. Is not that expensive because they're only covering you for 12 months. Okay? Again, if you've got a business expenses contract, be careful on that 12-month definition. Is it purely 12 months, or could it be 10 months, you go back to work for a month and then it's another 2 months? Because some will not do that. So you need to make sure it's 12 months in total. Okay, just check your business expenses contract. A problem for everyone, so just one insurance to be aware of. I mentioned very early on about making sure you haven't got an accident-only death policy, but you might only be able to get an accident-only policy. So if you're uninsurable for some reason or other, you've either got a pre-existing condition or you've got lots of little pre-existing conditions, the insurer might not want to insure you, and you might only be able to get what we call an accident-only policy. And there are some good accident-only policies out there. So income protection, total permanent disablement and death cover. If unfortunately you die by accident, you can be covered. So whilst it's not as comprehensive as being covered for illnesses as well, it's better than nothing. So if you've got that $2 million mortgage and you can't get the more comprehensive cover, you might just say, look, at least if I've got an accident-only cover, then at least if I do suffer that accident, then that will pay out. It doesn't cover trauma, because if you think about that logically, you're not going to get, very rarely you're going to get an accidental trauma. You don't accidentally get diagnosed with cancer, have a heart attack, etc. So I know there's an argument that some traumas you could argue can come from an accident, but they're not going to do trauma cover. So death, TPD, income protection. If for some reason you're uninsurable, talk to your advisor about accident-only contract. How do you structure your policy? Do you own it via super or do you own it via personally? Pros and cons. Death cover via super, no real issues with that. The premium is actually 15% lower because the super fund gets a tax deduction. You don't get a tax deduction for your life insurance premiums. However, that means that you've got premiums coming out of your super fund, and your super is designed to build your wealth, not to pay insurance premiums. So ideally, if you are paying insurance premiums via super, you should be making sure that you're topping up your super contributions to take into account the money that you're taking out of your super. So a good way of getting a lower premium, but just make sure that you're countering that by putting more into your super to make up for it, because you shouldn't be taking money out of your super to pay your insurance premiums. TPD, if you hold TPD through super and it's owned via super, there's a way of holding it inside and outside, and if somebody wants to talk about that, we'll take it offline because that'll take us even longer. But if your TPD is owned via your super fund, first of all, the payout, the claim goes to the super fund. You then have to meet a condition of release, and then the trustee pays it through to you. So it's not as effective from a time delay. However, most importantly, it is liable for tax. So on your $1 million that you're expecting to get from your TPD claim, the chances are that you'll pay around about 17% tax on it, or you'll receive your TPD claim less 17%. Whereas if you own it personally, you'll receive the full 100%. It's tax-free. Okay, so just be aware of that. So the way to counter that is you gross it up. When you gross it up, you pay more tax, so you have to gross it up again, and eventually you'll end up with the level of cover that you need. So just be aware of that. Same with income protection. It's not the tax element, it's the fact that it goes to the trustee first. You have to meet the condition of release, and then they will pay you the benefit. So life cover, yes. TPD and income protection, not solely owned by super, so you can structure it in a way that some of your premiums are paid via super and some are paid personally. Policy definitions. This is really, really important. This is why your advisor needs to know the contracts that they are recommending, and they need to know which insurers offer the best policy definitions. So just quickly, if you've got a definition that says the sickness or injury makes it unlikely that the person will ever be able to work in their own occupation again, versus a definition that says will not be able to work in their occupation again. As a specialist, if you're asked to sign off to say that a client will or is unlikely to be able to carry on the duties of their own occupation, you might feel quite comfortable in doing that. Based on what I can see, I believe that they are unlikely to be able to perform their own occupations. I'll sign their claim form as the medical specialist. If it says that they will never be able to work in their own occupation again, how comfortable are you as the specialist putting your name to something that says that client will never be able to work in their own occupation again? Who knows what's going to happen with medical technology, medical advancement? So you want a contract that says unlikely in their definitions. We've talked about own versus any. Here's one for you. The sum insured will become payable upon diagnosis of prostate cancer. The sum insured will commence upon the commencement of treatment for prostate cancer. There's a bit of a difference there. If the specialist decides that they're not actually going to start specific treatment for the prostate cancer, they're monitoring it, etc., I want my payout up there, not down here. Okay? So it's just your advisor being aware of different terms, different contractual definitions. Premium structure, stepped level premium. So step premium, everyone aware what a step premium is? Okay, so with a step premium, and I haven't got the whiteboard, so imagine stairs, your premium steps up each year. So it starts off somewhere between 50 to 100% lower than a level premium, and it steps up each year, and there are two factors that increase that premium. Indexation, usually around about 3% at the moment. I know inflation isn't 3%, but that's what the insurers will use, 2.5%, 3%, and an age-related increase. So imagine you're taking out the policy every year, it just gets higher with age, plus the indexation, and it steps up. Level premium, theory being that it starts off 50 to 100% higher, but it stays level, other than a slight indexation, 3% each year, and your benefit goes up by 3%, and usually round about the 12-year mark, the stepped premium overtakes the level premium, so your level then becomes cheaper thereafter. Other than when the insurers increase it by 30, 50, 100%, then it doesn't become cheaper. Step premiums are going up as well. So when we're saying level premiums are going up by these high numbers, so are step premiums, just not as much. Okay. So in early years, step premium might suit your circumstances. It means you can get the types and levels of cover that you need, but the premium's also affordable. If you can go to level, then great, because in theory, long term, you benefit from that long-term cost effectiveness, but we just say the whole insurance industry is kind of in turmoil at the moment around premiums, etc., especially on income protection, or more on income protection. The lump sums aren't really affected, it's the income protection that's being affected.
So Phil, that applies to all the different types of insurance?
Absolutely. So that's across all insurances. You can have a level premium, you can have a step premium, or you can have a hybrid. So you could have $1 million worth of cover, and 50% of that might be on a level, 50% might be on step, so to edge your bets. You could do that with income protection. 10,000 of your monthly benefit might be on a level premium, 10,000 might be on a step premium. Okay, so you've got options. So you can have stepped, you can have level, you can have hybrid. So up until very recently, level was always, or most of the time, was more cost effective than stepped in the long run. So provided you had 12, 13 years to run on that contract, then if it was affordable, you'd be better off level, or at least looking to get to level as quickly as you can. But if you hadn't got that long, then you might not reach that crossover point, and more importantly, you might not reach the crossover point for cumulative premiums. So what have you paid in total, which is normally a few years down the track, because it's okay breaking the line, but it's then the cumulative amount that you've paid. Okay.
You would be able to advise about which is best out of those depending on where you are.
Absolutely. So your advisor should advise you on what's best for your circumstances, taking into account current situations. But what we would do as well, and what an experienced advisor should do, is take into account what's going on in the market as well. Okay. So that's really important at the moment. Say more on the income protection. So if you're just looking at the lump sums, it's pretty much this is what it is. Let's take a look at your circumstances, level, stepped, hybrid, whatever meets your circumstances. So in the good old days, pre-IP changes, what you can see there is female doctor age 40, non-smoker, death cover 2 mil, TPD 2 mil, trauma 500, income protection 20k per month through to age 65, and business expenses of 6667 monthly benefit for 1 year. On the step premium, the initial premium was 15,845. On the level, it was 32, and on the hybrid, it was 20. But what you can see is that over time, the level premium after 25 years is substantially less than the stepped or the hybrid premium, but it's more expensive when we start off. Okay, so it's your personal circumstances. There is no right, there is no wrong. You just need to take into account, say, what suits you most at the time. And you can always change those. You can go from step to level, from level to stepped. So you can have that hybrid. So don't think that you're stuck once you're on a certain contract. So prioritise strategy over product. So make sure you're getting professional advice versus an insurance agent. An insurance agent differs from a financial advisor who only advises on insurances. There is a difference. Okay? There are some excellent financial advisors out there who only advise on insurance. Insurance arm's length advice, that's just going on to Steve's point to make sure that there's no direct connection between the advice you're receiving and the insurer that is being recommended to you. And if there is a direct connection, there needs to be a really, really good reason as to why that advisor is recommending that particular insurer. So if I recommend PPS or BT or MLC to you, be totally clear that the advisor has shown you quite clearly why they're recommending that insurer and why that insurer best meets your circumstances and your objectives. Types and levels of cover, so you prioritise the types and levels of cover over the product. The 5% rule of thumb, Steve mentioned this earlier, so people always ask how much should I be paying on my insurance premiums. We always look to make sure that the insurance premiums come in at less than 5% of gross income. Okay? Now, if it comes in at over 5%, then we look to see if we made a little bit of a mistake, if we got your date of birth wrong or whatever. It will come in at over 5% sometimes, because if you've got 10 million in debt and you want to cover that on death, on TPD, you've got a 30,000 or 40, 50,000 IP, the chances are it'll come in over 5%, but you need the cover. But other than that, it should be coming in under 5%. So with insurance, the insurer will pay the advisor a commission. Yep. And they will also, and now the good thing about that is that all insurers now pay the same commissions, whereas previously they paid varying levels, which gives you that, okay, you're recommending them because they might be paying you more. Yeah. That's now, at least that's gone because they all pay the same. And then, and then with most contracts, they'll also then pay you a renewal brokerage as well for those ongoing reviews. So the insurer is paying the advisor on your part. It's built into your premium, so you're not paying it additionally, but yeah, absolutely. So you want to be aware of, okay, how are you being remunerated? If you're not asking me to pay you 5-10 grand for your advice, how are you being remunerated? The insurer is paying me a brokerage, and they will be paying me an ongoing brokerage. Absolutely, yeah. Okay, so I'll go through these quite quickly. So application process. Don't be put off if the application process is difficult. They ask you to go for medicals, they ask you lots of questions, because if they've got all that information up front, then your claim should be quite successful, subject to it meeting the terms and conditions, because they've got all the information on you. If it was an easy process, you picked up the phone and said, I want $1 million worth of cover, please, and 20 seconds later you've got it, guess when they underwrite you? Time of claim. Okay? So when you see some of the adverts on telly, absolutely, you can pick up the phone, you can be covered in 2 minutes, and then when you go to claim, you'll find that pre-existing condition that they didn't ask you about actually means you're not going to get a successful claim. So if you've If you've been through the underwriting, you might have an exclusion, but at least you know about it, as opposed to finding out when you really needed to have a successful claim. Be careful when changing insurer. Absolutely, as Julie said, if for whatever reason you're looking to change your insurer, be aware that you're going to go through fresh underwriting. You may end up with terms that aren't as preferential as you've currently got because of medical reasons. Claims management. If unfortunately you ever have to put a claim in, the first person you go to is your financial advisor. That is one of the most crucial roles that they can play for you because they know how to get the claim through, they know how to answer the questions, they know the information the insurer is looking for, and hopefully they know the contract they've recommended to you and they know whether or not you're going to meet those definitions. We had a conversation with a very well-known insurer the other day who was basically telling a client they were going to get a partial claim on their income protection because of the definition and the fact that they were still working up to 10 hours per week during both the waiting period and also they will be working 10 hours during their claim. Due to the contract they've got, the client is allowed to do that and receive a full claim, so up to 10 hours but no more under the terms of their contract. The insurer is trying to impose a different definition of the contract. So we pointed out that they are allowed to do that and the claim will go through. So your advisor really needs to understand the claims process and the contracts that they're recommending. Okay, so risk needs analysis. This is going to be the fastest risk needs analysis ever done. But basically, what your advisor should be going through you is what we call a risk needs analysis, asking you what you want to happen given certain eventualities or certain occurrences. So, as an example, if unfortunately you die, do you want to repay your home loan? If unfortunately you suffer TPD, do you want to repay your home loan? Get rid of that burden either for yourself or for your partner if unfortunately you're no longer here. Do you want to pay off any other loans? Do you need to take into account an ongoing income stream because you're no longer here generating an income? What income does your family need to have to maintain the lifestyle, to have the children go for private education even though you're no longer here generating the income? So these are the types of questions that need to be asked. Do you need to take time off work because your spouse has suffered from a trauma? Well, if you take time off work voluntarily, none of your insurances are going to pay because there's nothing wrong with you. You're just taking time off to look after your spouse, your partner. So do you need to figure into your spouse's calculations time for you to take an amount for you to take time off work? So just relating back to the case study. So if unfortunately SIG died, they want to make sure the loans are covered in the event of death or TPD, so 1.227 million in both of those. They want to pay off the business loan, 250. In the event of TPD or trauma, they want to make sure there's a lump sum of money available that can help for things such as putting a ramp in at home, buying an adapted car, putting a stair lift in, medical treatment, so drugs that they might have to pay for personally that isn't covered by other insurances. Final expenses upon death. We're not just talking funeral, we're talking legal expenses to wind up your estate. Plus, depending on whether you're going for a cardboard box or a gold coffin, that can obviously vary hugely in the amount required. Time off work for Martha, so that's what I was just talking about. So unfortunately, SIG either dies or has a TPD. In this instance, Martha takes 3 months off work. That's 3 months worth of her net income if unfortunately something happens to SIG. Services of childcare or assistance. So if unfortunately he dies, there's an amount of money available to help Martha out with the kids around the house while she goes out to work. Here's a big one. If unfortunately SIG is TPD, an amount of money available to provide the ongoing services of a carer through to age 65. Why 65? Because he'll then have his investment assets and retirement assets to call upon to provide the ongoing income. So the money is invested and provides a regular ongoing income. You're drawing interest and you're drawing capital. So it's not just the interest we're relying upon, interest and capital from that $1 million or 1.1 million. Big one, fund the children's education, 360k. That is one of their main priorities. So no matter what happens, whether it be to SIG or to Martha, they want to make sure that money is available to put those kids through private education. So there's an amount of money that will be available. Now, the recipient of all this money, whether it's SIG, TPD, and trauma, or whether it's Martha, because unfortunately SIG's died, you can do what you want with the money. You don't have to pay off the mortgage, you don't have to pay the kids' school fees, but this gives you a good idea of formulating a picture in your own mind as what are the types of expenses and commitments that I would have if unfortunately something happened, and what type of financial commitment do I need to make to be able to make sure that I can cover those. Trauma, again, now you can pay off your mortgage if you want, but that's going to be really expensive. Or you can look at it as a short-term requirement. So I might need to pay for some medical expenses. I might need a small income stream, say to cover my living expenses for 2 or 3 months. I might want to allow my spouse to take some time off work. But if I suffer a trauma and it becomes long-term, so I have a severe stroke as opposed to a mild stroke and I go back to work, if I suffer a severe stroke, I'm going to be TPD'd. And then I'm going to pay my mortgage off, and then I'm going to have the services of a carer, etc. TPD is a lot less expensive than trauma cover. Okay? So you can see that all of that gave us sums insured of 2483, 3631 on TPD. TPD is quite often higher than death cover, a lot of the reasons because of this big lump sum here to provide for a carer, and 185 on trauma cover. Same analysis for Martha. You'll just see that there isn't an ongoing income stream because basically Sid can carry on working provided he's got help with the kids. They have elected to clear the mortgage, so he hasn't got that burden, so he can cut back a little bit, spend more time with family, etc. And also the 360, so he can definitely ensure that the kids get that education. So which insurer, going back to the comment with regards to, and I've cheated on this because I always forget, so TAL have recently purchased Astron. Astron was a huge insurer owned by Suncorp Life. Zurich have purchased OnePath, huge insurer. AIA have purchased ComInsure's risk book of business, not ComInsure, but the risk book of business. So AIA haven't purchased Commonwealth Bank, they've purchased their risk book of business. You've still got AMP, you've still got MLC, you've still got BT, etc. Okay, so which insurer? It's down to your advisor to pick the right insurer to meet your needs and circumstances. Okay, PPS, fairly new entrant from South Africa. There's also NEOS, Integrity, so there's some more players in the game. So again, it's just down to your advisor. Different advisors will have relationships with different insurers. So as long as the contract and the terms of that contract meet your objectives and your goals, then then any insurer can meet those objectives. I won't go through the case studies for the sake of time, but just basically make sure that your advisor has explained to you how the different insurances interlink. I did the Venn diagram last night. The only use of a Venn diagram in this world is to explain how income protection, TPD and trauma interlink or work independently. Estate planning is going to be covered later on by Ben and Craig, and they're the types of things you need to be looking at in your estate planning, but so they'll go through that in more detail. Just quickly on your super, make sure you're aware of who your nominated beneficiaries are on your existing super platforms. So in summary, review your foundations, talk to your advisor, go through the things that we've spoken about, and please, please, please review your income protection. Talk about the things with your advisor that we've spoken about. If you need me to recap during lunch or during the break, I will do. Apologies for having to go through so quickly. Obtain quality professional advice. Ensure it's impartial and it's unbiased. You generally get what you pay for, same as most things in life. And enjoy the peace of mind of strong foundations.